If you are over 40 and still believe that compounding is just about earning interest on your interest, you are not behind because of your age. You are behind because nobody ever told you compounding has rules. Secret rules. Laws that operate beneath the surface of every account, every portfolio, every dollar you have ever set aside or failed to set aside. And those laws do not care about your birthday. They care about your architecture. The people who build wealth after 40 are not the ones who suddenly find more money. They are the ones who finally understand how compounding actually operates when you stop treating it like a savings account feature and start treating it like a system with hidden gears. Most of what you have been told about compounding is incomplete. Not wrong exactly, but dangerously shallow. And that shallow understanding is why you feel behind right now. Today I am going to walk you through the secret laws of compounding that almost nobody discusses. Not the textbook version. The version that actually determines who builds lasting wealth and who spends decades spinning their wheels wondering what went wrong. Here is the reframe you need before we go any further. Your financial gap is not a math problem. It is a design problem, not income. Architecture. Most people approach compounding as if the only variable that matters is the rate of return. Get a higher percentage, get a bigger pile. That is the math mindset, and it fails people every single day. The architecture mindset is different. It asks how your money is structured, how your contributions flow, how your behavior interacts with the timeline, how your emotions either fuel or destroy the engine. When you shift from thinking about compounding as a calculator exercise to understanding it as a structural design challenge, everything changes. You stop chasing returns and start building systems. You stop comparing your portfolio to someone who started at 25 and start engineering a framework that actually fits your life at 43 or 47 or 52. The people who win with compounding after 40 are architects. They are not gamblers. They are not stock pickers. They are builders who understand that every single law we are about to cover is a load-bearing wall in the structure of their financial future. Remove one, and the whole thing weakens. Respect all of them, and the structure becomes something that cannot be easily torn down. Not math, architecture. That distinction will carry you through everything that follows. Law number 1, the law of uninterrupted time. Most people think compounding rewards early starters. That is partially true. But what compounding actually rewards is uninterrupted commitment. A person who starts at 28 and pulls their money out at 35 during a panic, then restarts at 38, then pauses again at 41, will often end up with less than someone who starts at 42 and never stops. Every interruption resets the curve. Every emotional exit, every pause to rethink, every withdrawal to cover something that felt urgent at the time, each one of those moments kills years of future growth you will never see or feel in the present. The first law of compounding is not start early. It is start and do not stop. A 45-year-old who commits today and stays committed for 20 unbroken years will harness more compounding power than most people who technically started a decade sooner but kept interfering with the process. The secret is not when you begin. The secret is whether you stay. That is the trap. People believe they need a time machine. They do not. They need an unshakable commitment to never interrupt the engine once it is running. 20 unbroken years from today puts you at 62 or 65 with a compounding curve that bent violently upward in the final stretch. That final stretch is where the real money lives, but only if you never pulled the plug along the way. I want to pause here for a moment. Drop a number in the comments. How old were you when you first seriously started thinking about building wealth? Not daydreaming about it. Actually doing something about it. 25, 38, 51? There is no wrong answer. The only wrong answer is pretending the question does not matter. Drop your number. I want to see where this community stands because the answer tells you something important about the gap between awareness and action in your own life. And that gap is exactly what we are closing today. Law number 2, the law of invisible erosion. This is the most dangerous law because it works against you silently. Invisible erosion is what happens when fees, taxes, and inflation quietly eat your returns before compounding ever gets a chance to do its job. Here is a real number. If you earn 8% annually on your investments, but you are paying 1.5% in management fees and losing another 2% to inflation, your real compounding rate is not 8%. It is 4.5%. Over 20 years, that difference is not small. On a $200,000 portfolio, the gap between compounding at 8% versus 4.5% over 2 decades is roughly $400,000. That is not a rounding error. That is a retirement. Most people never do this calculation. They see the gross return, they feel good, and they never realize that invisible forces are siphoning off nearly half the engine's power. That is the trap. The most dangerous enemy of your compounding is not a market crash. It is the quiet bleed you never notice. Low-cost index funds versus high-fee managed accounts. Tax-advantaged retirement vehicles versus taxable brokerage accounts. These are not minor choices. They are architectural decisions that determine whether your compounding engine runs at full capacity or limps along at half speed for decades. Think about that. You could do everything else right and still lose because you never addressed what was quietly draining the tank. Law number 3, the law of reinvestment identity. Here is something most people never see. Compounding does not just apply to money. It applies to your identity as an investor. Every dividend you reinvest instead of spending, every return you roll back into the portfolio instead of withdrawing, every month you automate a contribution without questioning it, those are not just financial actions. They are identity actions. You are training yourself to be the kind of person who builds. And that identity compounds too. The person who has reinvested consistently for 36 months makes fundamentally different decisions than the person who is still trying to decide whether to start. Their risk tolerance is different. Their emotional resilience is different. Their relationship with market volatility is different. They do not panic during a 15% correction because they have already survived 3 of them and watched their portfolio recover every time. Think about that. The most powerful compounding asset you own is not a stock or a fund. It is the behavioral pattern you are building with every single decision to stay in and keep going. A person at 44 who has reinvested every dividend for 2 straight years has built something most 30-year-olds never develop, an investor identity that does not flinch. That identity is invisible on any balance sheet. But it is the mechanism that holds everything together when markets get ugly. And markets always get ugly eventually. If you are finding value in this, the Trip2 Wealth Command Center Google Sheet is linked below. It is the tool we built specifically to help you track the laws we are covering today in your own financial life. Go and get it. Now, what comes next changes the entire conversation. Because everything so far has been diagnosis, identification of the hidden laws working for you or against you. What comes next is the decision. And I do not mean a decision about which stock to buy or which fund to pick. I mean the decision about what kind of financial life you are going to architect from this point forward. Everything so far is diagnosis. The next is the decision. Not knowledge. Decision. You can understand every law of compounding perfectly and still end up broke. I have seen it happen. I have lived adjacent to it. The difference between the person who understands compounding and the person who benefits from it is a single moment of commitment. Not motivation. Commitment. Motivation fades by Thursday. Commitment survives the months when your portfolio drops 12% and your coworker is telling you about the killing he made in some speculative trade. There are 2 paths from this point. One path is to consume this information, feel inspired for a few hours, and then drift back into the same patterns that brought you here. The other path is to take what you have heard, sit down this week, and make one structural change to the way your money flows. Automate a contribution. Move to a lower fee fund. Open a Roth IRA if you have not already. One architectural decision. Not a dramatic overhaul. One load-bearing wall placed with intention. The people who build irreversible wealth are not the ones who had dramatic moments of transformation. They are the ones who made quiet decisions and then refused to undo them. My friend, the decision is not about perfection, it is about permanence. Choose one thing, lock it in, protect it from your own future doubt. Law number 4, the law of strategic patience. This law is where people who are almost there fall apart. They have done the work. They have been consistent. They are 3 or 5 or 7 years into their journey. And then they start over-monitoring, checking their portfolio daily, comparing monthly returns to benchmarks, reacting to every headline, reading market predictions from people who have no idea what will happen next quarter. Over-monitoring is not diligence. It is anxiety disguised as responsibility. And it destroys the very patience that compounding requires to function. Here is what the data shows. If you had invested $10,000 in the S&P 500 20 years ago and stayed fully invested, you would have seen significant growth. But if you missed just the 10 best trading days during that period because you pulled out during a scare and got back in too late, your returns would be cut roughly in half. 10 days out of roughly 5,000 trading days. That is how razor-thin the margin is between strategic patience and reactive destruction. Built with intention means you set the architecture and then you step back. You check quarterly, not daily. You rebalance annually, not emotionally. You trust the structure you built when you were clear-headed, and you do not let a Tuesday afternoon headline convince you to tear it apart. The calendar on your wall should have 4 dates circled per year for portfolio review. That is it. The rest of the year, your job is to live your life and let the engine run. Stop for a moment. Has anything shifted for you so far? If something clicked, drop your number again in the comments, or just type "I see it now." I want to know what landed, because these laws are not theoretical. They are operational, and the moment one of them clicks for you personally is the moment your architecture starts to change. Now let me complete the picture. There are 3 more laws that tie everything together, and these are the ones that make wealth irreversible. Law number 5. The law of compounding. Across domains, money is not the only thing that compounds. Your financial knowledge compounds. Your network of people who take money seriously compounds. Your ability to recognize opportunity compounds. Every book you read about investing, every conversation you have with someone who has built wealth, every hour you spend understanding tax strategy or asset allocation, all of that knowledge stacks on itself the same way interest stacks on principal. A person at 47 who has spent 3 years deeply studying personal finance makes fundamentally better decisions than a 30-year-old with a brokerage account and no framework. You are not just building a portfolio. You are building a decision-making engine that gets sharper with every cycle. The investor who understands why they own what they own does not panic. The investor who can read a fee disclosure and calculate the real cost does not get exploited. The investor who has built relationships with other serious wealth builders does not feel isolated when the market drops 20%. This law is about recognizing that your money grows faster when you grow faster, and growth at 45 or 50 is not slower than growth at 25. It is often deeper because you have more life experience to anchor it to. Compound your knowledge, compound your circle, compound your clarity. The money follows. Law number 6, the law of lifestyle architecture. Every dollar you spend on inflating your lifestyle is a dollar that never enters the compounding engine. Let me be direct about that. This is not about deprivation. This is about awareness. When your income goes up by $500 a month and your spending goes up by $500 a month, your compounding rate stays exactly the same. Nothing changed. You just feel richer while being structurally identical to where you were before. The wealthiest people I have studied do not have the biggest incomes. They have the biggest gap between what they earn and what they consume. That gap is the fuel line to the compounding engine. A person earning $85,000 a year who lives on $60,000 and invests $25,000 will build more wealth over 15 years than a person earning $150,000 who lives on $145,000 and invests $5,000. The math on this is not even close. Lifestyle architecture means you make deliberate decisions about your standard of living, and you hold that line even when your income climbs. Not because you are punishing yourself. Because you understand that every dollar of gap between earning and spending is a soldier that never stops working for your future. Law number 7, the law of irreversible momentum. This is the law that changes everything. There is a point in every compounding journey where the growth becomes self-sustaining, where even if you stopped contributing entirely, the engine would continue to grow at a pace that outstrips what your contributions alone could ever achieve. For most people investing consistently at a reasonable rate of return, this tipping point arrives somewhere between the 10 and 15-year mark. Before that point, your personal contributions are doing most of the heavy lifting. After that point, the compounding itself takes over. Your money starts earning more each year than you are putting in. That is irreversible momentum. That is the point where wealth stops being something you chase and starts being something that chases you. And here is the part that matters most for anyone starting after 40. If you are 44 today and you commit to 15 unbroken years of disciplined, automated, architecturally sound investing, you hit this tipping point at 59. Your money is now working harder than you are. Your 60s become about choices, not obligations. That is irreversible wealth. Not because the number is huge, because the structure is permanent. The engine runs on its own. The momentum cannot be undone by a single bad month or a single bad year. It is too deep, too well built, too far along the curve. Now here is your diagnostic. I want you to answer this honestly. Question 1. Do you have automated monthly contributions going into an investment account right now? Yes or no? Question 2. Do you know the total annual fees you are paying across all your investment accounts? Yes or no? Question 3. Have you gone 12 consecutive months without withdrawing from or pausing your investment contributions? Yes or no? Question 4. Can you name your actual after inflation, after fee rate of return from last year? Yes or no? Question 5. Do you have a written plan for how your investment strategy aligns with your specific retirement age? Yes or no? If you answered no to 3 or more of those questions, you are not behind on wealth. You are behind on architecture. The money was never the problem. The structure was. And structure can be fixed at any age, at any income level, starting this week. This is not about catching up. It is about building correctly for the first time. You do not need more time. You need better architecture. The 7 laws we covered today are not motivational slogans. They are structural principles. Uninterrupted time, invisible erosion, reinvestment identity, strategic patience, compounding across domains, lifestyle architecture, irreversible momentum. Each one is a load-bearing wall. Miss one and the structure weakens. Respect all of them, and you build something that cannot be easily broken. My friend, you are not behind because of your age. You are not behind because you did not start at 25. You are behind because no one ever showed you the blueprint. Now you have it. Build it with intention and wealth becomes irreversible. That is it. If this breakdown brought you clarity, I highly recommend watching my next video. Don't forget to like, share, and subscribe to our channel. Also, feel free to leave your comment below, especially if this video made you think differently. Thanks for watching. I'll see you in the next one.